all of the central banks who have been the biggest buyers of gold in the world to raise it to a higher level, to allow the offsetting of gold against your balance sheet liabilities. And I think it's something that they notice. And when Cynthia Loomis, the senator from Wyoming, says it, to me it's a whole lot more noticeable than when the head of the Dutch National Bank says it. But the fact that both of them are saying it, to me, tells me that the West understands it, notices it, but so does the East. And these are the countries that are buying it and producing it and possessing it in a way that, you know, is we've never seen before. So yeah, I think there's a probability, don't know how high of probability, but better than ever before, that is on the table, and it would immediately not only render countries' balance sheets in good order, but it would reestablish credibility in a system that is massively lacking it. No one trusts it anymore. No one trusts politicians. That's why there are ridges on coins. First of all, Janet Yellen could just say this is what it is. She doesn't need congressional approval. She can tell Jerome Powell, I want you to revalue gold to this number. The head of the Dutch National Bank has been talking about this for a long time. He said, we should revalue the gold that we have that's worth 20 or 30 billion euro right now. It's valued at 35 bucks an ounce across the board on all the European countries. It's still the Bretton Woods number. In the U.S., it's valued at 42.22. They revalued it or made it official sometime after it was released from the peg in 71. But anyways, the bottom line is that you can't make it up. Every single central bank balance sheet holds gold in what's called the gold revaluation account. And as it is right now, the gold that is held in these accounts is not able to be to offset liabilities. And so the way that they hold it, it's the gold that they physically hold is in an asset on their balance sheet, but on the liability side is something called the gold revaluation account, which mirrors the amount of gold in the asset category. So it offsets one another, balances out. There isn't an ability, if you will, to offset it at this point against assets or liabilities rather. And so the head of the Dutch National Bank keeps saying, we need to do this, we need to do this. Well, it became even more relevant when Cynthia Loomis, the senator from Wyoming, speaking at the Bitcoin conference in Tennessee, after Trump got off the stage talking about establishing a strategic Bitcoin account to help pay down the debt, she got up and said, yes, and I'm going to submit a bill requesting that we revalue the gold that the Federal Reserve is holding on behalf of the Treasury to fund this. And so you're getting more and more and more people talking about it. You have Jim Rickards as an example, $27,000 an ounce. You value it, the gold held at Fort Knox supposedly, which hasn't been audited since '53, against M1. And there are others that will use M2 and do it. And whatever the number is, look, every $4,000 increase in gold would give a $1 trillion free and clear deposit into the Treasury General account, as crazy as this sounds, okay? And I'm not, I did an interview with Michelle McCory of Kitco, and I said this, and that's actually the title that they ran with, and is that you put it 130 or 140,000 an ounce, as nutty as that sounds, and just make a decree and say any government that wants to send their gold to the U.S. Treasury will pay them $130,000 an ounce. That value, based upon the 8,300 and whatever 30 metric tons we have, would our 36 trillion in debt almost completely balanced with our assets. Is it crazy? Over my shoulder is President Roosevelt. This is when gold, everyone owned gold. In 33, it was currency. He confiscated it, and then by decree devalued the dollar by 40%, increasing the price of gold by 40%. It happens. It's happened. Could it happen? Yeah, why not? It's probably a lot easier than outright default or hyperinflation. Yes, it would create inflation, but it's probably something that would they notice as being less painful than the other options. But could it happen? Yeah, I think that is. Look, why would the most powerful bank in the world, the BIS, reclassify gold as the world's only other tier 1 reserve asset next to U.S. treasuries and dollars after almost 80 years of it just being dollars and treasuries?
Treasuries and dollars. After nearly 80 years of it solely being dollars and treasuries, the reassessment of gold has long been a subject of debate among policymakers, economists, and financial analysts. It's not merely a theoretical concept. It's a viable approach that central banks, especially in the West, are contemplating as they steer through an increasingly intricate and debt-laden global economy. The script above presents a persuasive case for why adjusting gold's value is more pertinent than ever. Let's explore the mechanics, consequences, and potential avenues for this decisive measure. Gold has consistently been the foundation of monetary frameworks. For centuries, it supplied the stability and confidence that paper currencies inherently lack. In today's era, where fiat currencies are perpetually diminished through inflation and imprudent monetary policies, gold remains the ultimate safeguard. But beyond serving as a hedge, it is now surfacing as a possible remedy for tackling national debt crises and reinstating confidence in monetary systems. Janet Yellen, as mentioned, could independently instruct Jerome Powell to adjust gold's value. This isn't without precedent. Historical instances, such as President Roosevelt's 1933 Gold Reserve Act, illustrate that governments have employed gold revaluation as a mechanism to navigate economic turmoil. Roosevelt's action depreciated the dollar and raised the official value of gold, effectively reducing a segment of the debt load through inflation. The question is, could this approach be effective once more? The response lies in grasping the dynamics of gold revaluation in today's context. Gold possessed by central banks is recorded on financial statements at obsolete valuations. $4.22 per ounce in the U.S., for instance. Adjusting gold's value to market rates or beyond could instantaneously inject liquidity into treasuries. A single $44,000 surge in gold's price per ounce would contribute $1 trillion to the U.S. Treasury's general fund. Envision the fiscal relief that would generate. One of the most revealing signals of gold's future significance is the conduct of global central banks. Central banks are acquiring gold at levels unseen in contemporary history. As per the World Gold Council, central banks procured over 1,136 tons of gold in 2022 alone, the highest annual figure since 1950. Why this sharp rise in gold accumulation? The rationale is twofold: risk mitigation and anticipation of a transformation in the global monetary framework. Nations like Russia, China, and India have long acknowledged the weaknesses of the dollar-centric system. By amassing gold, they're safeguarding against potential dollar depreciation and positioning themselves for a future where gold could assume a pivotal role in trade and reserve structures. It's important to highlight that this surge in gold acquisition isn't confined to the East. European central banks, too, are reclaiming gold from overseas depositories and bolstering their reserves. The Bundesbank's effort to retrieve gold from vaults in New York and Paris exemplifies this shift. These maneuvers indicate a mounting skepticism in fiat systems and a revived belief in gold's reliability. Skeptics contend that adjusting gold's value to extreme levels, $130,000 per ounce, for instance, is implausible. Yet, history indicates otherwise. Central banks and governments have a long record of enacting substantial interventions during financial crises. The Bank for International Settlements, BIS, recently reclassified gold as a Tier 1 reserve asset, equating it with cash in U.S. Treasuries. Why implement such a change if gold weren't integral to forthcoming monetary frameworks? Furthermore, revaluation isn't simply an abstract notion. It's a practical instrument that could stabilize economies, alleviate debt obligations, and restore trust in monetary policies. As Andy Schectman observes, adjusting gold's value wouldn't eradicate inflationary strains, but it might be regarded as the lesser of two evils compared to hyperinflation or outright financial collapse. The West's sluggish gold strategies starkly contrast with the assertive gold acquisitions witnessed in the East. China, for instance, is not forthcoming about its gold reserves. While official records report 3,000 tons, many analysts suspect the actual quantity is significantly greater. China has been mining gold at inefficient costs, importing vast amounts, and utilizing sovereign wealth funds to discreetly accumulate more gold. Similarly, Russia has expanded its gold reserves fourfold over the past 15 years. These countries are not merely protecting themselves against the dollar. They're preparing for a multipolar financial landscape where gold could function as the cornerstone of a new trade and reserve framework. The West, conversely, continues to underestimate gold's strategic relevance. How much longer can this pattern persist?
If they didn't have something big in store for gold, why would the central banks be buying gold at a level the world has never seen before and repatriating it? Literally, no one's in 100 years of central banking, nothing like what they've been doing the last few years has ever happened before, where they're buying gold hand over fist. Of course, it is the only other tier one asset in the world, and they're all repatriating that gold at the same time. Why would the head of the IMF say, write a report in 2023 saying gold as an international reserve currency, comma, a barbarous relic no more, question mark? Why would Kristalina Georgieva, the head of the IMF, say a CBDC not pegged to something is just fiat? And of course, in principle, we already see that the unit settlement token is 40% gold. I've been saying for 4 years now, the only way to legitimize a new system is to marry blockchain technology with gold. And that's indeed, I think, where we are ultimately heading. But in order, if you look at the 40%, that's what the Swiss used when their currency was backed by gold, 40%. That gives 60% monetary latitude, money creation and whatnot, enact or use monetary tools. So yes, I think, as crazy as it sounds, that it would benefit all of the central banks who have been the biggest buyers of gold in the world to raise it to a higher level, to allow the offsetting of gold against your balance sheet liabilities. And I think it's something that they notice. And when Cynthia Loomis, the senator from Wyoming, says it, to me it's a whole lot more noticeable than when the head of the Dutch National Bank says it. But the fact that both of them are saying it, to me, tells me that the West understands it, notices it, but so does the East. And these are the countries that are buying it and producing it and possessing it in a way that is we've never seen before. So yeah, I think there's a probability, don't know how high a probability, but better than ever before, that is on the table, and it would immediately not only render countries' balance sheets in good order, but it would reestablish credibility in a system that is massively lacking it. No one trusts it anymore. No one trusts politicians. That's why there are ridges on coins. Because you go all the way back to the Roman time, and they had to pay their soldiers all around, this expanding empire. So it's getting more expensive. So they would just lightly trim around each of the coins and get a pile of shavings that they could melt down and fashion into more coins. And that's just politicians' way of choosing inflation over the tough decisions or over austerity. It was true back then, and it's true now. So the only way you will ever get, I think, credibility in a system is to peg it to gold. And if you don't want it to be redeemable, because, convertible currencies convert. President de Gaulle proved that. I think you just tie it to blockchain and make it very, very transparent and very open, and you have a system that has a fighting chance of credibility and sustainability. So yes, I do think ultimately that is on the radar, and probably a higher probability than people would give credit to.
As the world confronts escalating economic difficulties, the significance of gold has never been more vital. In the initial section, we examine the processes and reasons for adjusting gold's value alongside the East's assertive accumulation strategies. Now, let's delve further into how gold integrates into the global financial framework, its geopolitical ramifications, and why individual investors should regard this moment with seriousness. Gold has always held a crucial position in global power relations, and today is no exception. The East, spearheaded by China and Russia, is deliberately weakening the dollar's supremacy. Their approach isn't solely about replacing the dollar, but about constructing a multifaceted financial network that depends on commodities, chiefly gold. Consider the BRICS nations, for example. These countries are no longer merely economic rivals to the West. They're actively restructuring the global financial system. The BRICS coalition's latest initiatives, such as establishing a fresh payment network, BRICS Clear, and commodity trading platforms, illustrate their determination to function autonomously from the dollar. Gold serves as the fundamental link binding these efforts together. Without a mutual fiat currency, gold emerges as the default settlement method, fostering trust and reliability in international commerce. For instance, envision China exporting goods to Russia and obtaining rubles in return. Instead of being concerned about currency instability, the two nations can settle their balances using gold on a net basis every quarter. This completely eliminates the dollar from the process. In 2022 and 2023, central banks worldwide accumulated over 1,000 tons of gold annually. Why? Because they perceive something that the average investor frequently overlooks. Fiat currencies are inherently volatile. The more dollars, euros, or yen that are produced, the less each unit retains its worth. Gold, conversely, cannot be diminished by central bank policies. When central banks stockpile gold, they're not merely making a financial choice. They're demonstrating their skepticism toward the existing monetary structure. The BIS's reclassification of gold as a Tier 1 reserve asset was intentional. This decision placed gold on equal footing with cash in U.S. Treasuries, a definitive recognition of its essential role in the future financial system. For individual investors, this serves as a stark reminder. If central banks, with their extensive resources and insights, are rushing to secure gold, shouldn't you? The concept of revaluing gold to tackle national debt issues isn't novel, but it is gaining momentum. Picture this: the U.S. Treasury, holding 8,300 tons of gold, opts to adjust the metal's value to $130,000 per ounce. This single action could reconcile financial records, transforming $36 trillion in national debt into more manageable proportions. Critics assert that such an action would fuel inflation, but let's evaluate the alternatives. Hyperinflation or outright insolvency, both significantly more disastrous. Adjusting gold's value is the least damaging route for governments seeking to regain economic stability. Historical examples, such as Roosevelt's 1933 gold adjustment, indicate that such policies can succeed. The advantages aren't exclusive to the U.S. Other countries with substantial gold reserves could leverage revaluation to stabilize their economies, attract foreign capital, and lessen dependency on unpredictable fiat currencies. This is why policymakers, from the Dutch National Bank to U.S. Senator Cynthia Lummis, are openly addressing the possibility of gold revaluation. One of the most intriguing advancements in the gold market is its potential fusion with blockchain technology. Imagine a scenario where every ounce of gold is tokenized, forming a transparent, unalterable record of ownership. This would resolve one of the biggest objections to gold: its lower liquidity compared to fiat currencies. Blockchain-based, gold-backed currencies could transform global finance. They would merge gold's reliability with the efficiency of digital transactions, offering a genuine alternative to traditional money. This isn't science fiction. The International Monetary Fund, IMF, has already proposed the idea of a blockchain-based global currency supported by gold. Such a system would also enhance gold's accessibility for individual investors. Instead of acquiring physical bullion or coins, you could hold fractional gold via digital tokens. This broader access to gold ownership could substantially boost demand, driving prices even higher. While gold frequently commands attention, silver remains the overlooked powerhouse of the precious metals sector. Often described as gold on steroids, silver presents even greater growth potential during market upswings. Its dual purpose as both a monetary metal and an industrial resource makes it uniquely positioned to benefit from worldwide economic transformations. The gold-to-silver ratio, currently around 80-1, is a glaring outlier. Historically, this ratio has averaged closer to 15-1. As gold's value climbs, silver typically surpasses it in performance, narrowing this divide. For investors, this renders silver a compelling high-risk, high-reward option. Industrial demand for silver is also surging, thanks to its indispensable role in sustainable technologies like solar panels and electric vehicles. Coupled with rising monetary demand, this creates conditions for substantial price escalation. Investing in gold and silver. How to begin? Acquire physical metals. Coins and bars provide the highest level of financial security. They are tangible, untraceable, and immune to third-party obligations. Evaluate ETFs and mining stocks. While not as secure as physical metals, these options offer liquidity and leverage. Just be mindful of the risks. Explore digital gold solutions. Emerging platforms that digitize gold ownership provide a contemporary alternative. These allow you to hold fractional gold amounts and trade them like stocks. Diversify with silver. Silver carries higher potential returns, but also exhibits greater price swings. A well-balanced portfolio should incorporate both metals. Stay updated. Follow reliable sources. Review reports from organizations such as the World Gold Council, and pay attention to leading industry figures. The indicators are undeniable. White heavy checkmark central banks are stockpiling gold. White heavy checkmark global tensions are prompting nations to seek substitutes for the dollar. White heavy checkmark blockchain innovation is unlocking new possibilities for gold's role in contemporary financial systems. White heavy checkmark the debt crisis is compelling policymakers to explore daring, unconventional strategies. For individual investors, this presents a rare opportunity. Gold and silver are more than just protections against inflation. They are keys to financial independence. By taking action now, you can position yourself not only to withstand, but to prosper in the forthcoming economic shift. As Andy Schectman states, gold is not merely currency. It's wealth. It's stability in an unpredictable world. Whether you're a nation or an individual, the path forward is unmistakable. Invest in gold and silver to safeguard your financial future. Stay updated with the latest developments shaping the precious metals market with consistent updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive Envelope with Thorough instant notifications on silver and gold price movements.
Don't forget to like our video and subscribe to our channel. Your comments are very valuable to us. Please make a small comment.